Imagine waking up one morning to find your job gone, your savings frozen, and your bank doors locked, and realizing too late that the only thing standing between survival and disaster was a plan you never made. This is Hidden Finance, where we uncover the secret patterns, buried decisions, and hidden structures that quietly shape who loses everything and who walks through the storm untouched. Throughout history, financial catastrophes have always seemed to appear out of nowhere. A market crash, a bank failure, a pandemic, a currency that suddenly becomes almost worthless. But when you zoom out, the surprising truth is that the storms are rarely the real story. The real story is who prepared before the sky turned dark. And again, it's the existence or absence of a clear financial plan that decides who falls and who survives. To understand how a financial plan can literally save millions, we need to go back to a time when almost no one had one. In the 1920s, the United States was riding a wave of euphoria. Stock prices were soaring, credit was easy, and everyone from waiters to factory workers was investing. The idea of risk management, of building a safety net, of planning for a once-in-a-lifetime crash, it all felt unnecessary, even pessimistic. Why plan for rain when the sun has never looked brighter? Families borrowed to buy cars, houses, and stocks with money they didn't really have. Banks lent aggressively with almost no protection for depositors. Margin loans, borrowing to buy stocks, let people control huge positions with a tiny sliver of cash. There were no emergency funds, no deposit insurance, no widespread culture of personal financial planning. The system was essentially built on hope, and hope is not a plan. When the stock market crashed in October 1929, hope vanished overnight. Within a few years, nearly 9,000 banks failed in the United States. Millions of people saw their life savings simply disappear. Unemployment surged to around 25%. For families who had borrowed heavily or kept everything in a single vulnerable bank, there was nothing left to fall back on. No safety net, no backup strategy, no plan B, but not everyone lost everything. Scattered among the wreckage were families, businesses, and even a few local banks that survived, not because they were smarter, but because they were prepared. They had low debt, they kept some cash reserves, they owned productive assets like land or small businesses instead of only speculative stocks. They had, even if they didn't use the term, a kind of financial plan, a simple, deliberate choice to avoid overextending in good times. The Great Depression forced an entire nation to understand the cost of living without a plan, not just at the personal level, but at the system level. By 1933, confidence in banks was shattered, and people literally stuffed cash into mattresses because they trusted no one. In response, President Franklin D. Roosevelt and Congress built something revolutionary, a financial plan for the banking system itself. This plan took shape as bank regulation, deposit insurance through the FDIC, and strict limits on how banks could gamble with customer deposits. For ordinary Americans, this plan changed everything. A guarantee on deposits meant that people could keep money in banks without fear of losing it to a run. The government's broader financial architecture, Social Security, unemployment insurance, public works programs, became part of a national financial plan designed to prevent total collapse of the middle class. It wasn't perfect, but it saved millions from starvation, homelessness, and complete ruin. And it created a powerful lesson: structure and planning, built before the next crisis, can turn a catastrophe into something survivable. Over the next decades, the world rebuilt, grew, and inevitably forgot. By the late 1960s and 1970s, a different kind of crisis came into view, one that most personal and national financial plans weren't ready for: inflation. Oil shocks, war spending, and changing global dynamics sent prices soaring. The value of money itself began to erode, quietly punishing those who held their wealth only in cash or fixed pensions. Imagine being a retiree in the 1970s living on a fixed income. The check you received from your pension or savings was the same number every month, but the price of food, rent, and fuel kept rising. Suddenly, a safe plan that relied only on cash and bonds didn't look so safe. On the other hand, those who owned real assets, like property, businesses, or shares in companies able to raise prices, had at least some built-in protection. Their financial plan wasn't perfect, but it was diversified enough to adapt. The 1970s taught a second brutal lesson. A financial plan isn't just about surviving a crash, it's about surviving the slow, invisible theft of purchasing power over time. Governments learned to integrate this into their own plans. Central banks began targeting inflation. Some countries developed long-term strategies for energy independence and resource management to reduce vulnerability to commodity shocks. On both personal and national levels, planning now had to account for a new enemy, not just losing money in a crash, but losing value quietly, year after year. Elsewhere in the world, the stakes were even higher. In Latin America, episodes of hyperinflation erased savings in weeks. In Asia, the 1997 financial crisis crippled economies that had grown rapidly but allowed dangerous levels of foreign currency borrowing. But a few countries, like Singapore and Chile, approached prosperity differently. They built large national reserves, sovereign wealth funds, and strict fiscal rules, a form of national financial planning that prioritized buffers over short-term popularity. When storms hit, these countries didn't escape pain, but they avoided catastrophe. Then came the 21st century, and with it, a new kind of optimism and a new kind of vulnerability. The dot-com bubble of the late 1990s and the housing bubble of the 2000s were built on the belief that this time is different. Tech stocks could only go up. Housing prices could never fall everywhere at once. Households, corporations, and even governments stacked up debt based on these assumptions. Once again, most people had no real financial plan. They had hope, leverage, and a belief in endless growth. When the housing bubble burst in 2008, it wasn't just Wall Street that suffered. Ordinary people lost jobs, homes, and retirement savings. Many had taken out mortgages they could barely afford, with little cash saved for emergencies. Their entire financial future rested on a single assumption: house prices would keep rising. When that assumption failed, their lives collapsed with it. No diversification, no buffer, no plan B, and yet, amid the chaos, there were people and institutions that stayed afloat. Individuals with even a few months of living expenses saved bought time to find new work. Those who had diversified, not just into real estate, but into broad stock indexes, bonds, and maybe a side business, saw setbacks, not annihilation. Some who stuck to a long-term investment plan through the 2008 crash eventually saw their portfolios recover and grow beyond previous highs. The difference wasn't luck. It was a structure they'd built long before the headlines turned red. The pattern repeated again in 2020, but on a global scale never seen before. A virus shut down the world economy almost overnight. Planes were grounded, offices emptied, small businesses shuttered. Within weeks, tens of millions lost their jobs. For businesses and households running on razor-thin margins, with no cash cushion and no backup plan, it was devastating. For many, this was the moment they realized that "I'll figure it out later" is not a strategy, it's a gamble. Governments, too, were put to the test. In the United States, Europe, and parts of Asia, a decade of relatively stable growth had allowed some room for massive emergency spending. Stimulus checks, unemployment enhancements, business loans, and central bank interventions poured trillions into the system. This was a kind of emergency financial plan for the entire economy, created in real time, on a scale never attempted before. It didn't prevent all suffering, but it did avert a total collapse of demand that could have spiraled into a new Great Depression. Of course, those extraordinary plans came with new costs: soaring public debt, asset bubbles, and the inflation pressures many countries are wrestling with today. That's the hidden catch with last-minute financial planning at the national level and in your own life. When you wait until the crisis hits, the rescue almost always has a price. You can survive today, but you may be borrowing stability from tomorrow. When you look across a century of financial history, a single truth emerges: the world will always have another shock. Sometimes it arrives dressed as a market crash. Sometimes as inflation, a pandemic, a war, or a technological upheaval that wipes out entire industries. The details change, but the core question does not. When the next storm hits, will you be improvising in panic, or simply turning the page in a plan you've already written? And that brings us to what's coming. Today, global debt, government, corporate, and personal, is at or near record highs. Populations in many developed countries are aging, straining pension systems and healthcare budgets. New technologies like artificial intelligence threaten to reshape job markets at a speed that could leave millions scrambling to reskill. Climate change and geopolitical tensions add layers of uncertainty. The next crisis may not look like 2008 or 2020. It might be a mix of several pressures colliding at once. In that world, hoping that someone will bail me out is a fragile strategy. Governments may not always have the political will or the financial capacity to send out stimulus checks or backstop every industry. Central banks may be constrained by inflation, limiting their ability to slash interest rates and flood the system with money. Safety nets will still exist, but whether they're generous enough, fast enough, or stable enough is an open question. Depending entirely on them is like depending on an umbrella someone else might or might not hand you in a hurricane. So what does a real financial plan look like? The kind that has already saved millions in past crises and could save you in the next one. It starts with something deceptively simple: clarity. Clarity about your income, your expenses, your debts, your assets, and your goals. Most people drift through their financial lives reacting to events. A plan forces you to step back and decide, on purpose, how you will handle a job loss, a medical emergency, a bear market, or a sudden surge in inflation before they happen. At the personal level, the pillars of a crisis-ready financial plan are remarkably consistent, whether you're a teacher, a freelancer, or a small business owner. First, an emergency fund, money set aside, not for a vacation or a car, but to buy you time when everything goes wrong. It's unglamorous, it earns little interest, but it's the difference between making calm, rational choices in a crisis and taking the first terrible job or loan you're offered because you're desperate. Second, a thoughtful approach to debt. In good times, debt feels harmless, even profitable, especially if asset prices are rising. But in every major crisis, those who are over-leveraged are the first to fall. A real financial plan sets clear limits on how much you will borrow, why you are borrowing, and how quickly that debt will be paid down. It assumes that interest rates can rise. It assumes that asset prices can fall. It assumes that easy money can disappear. Third, disciplined investing. The people who survived and even thrived after 1929, 1973, 2000, 2008, and 2020 weren't those who guessed every top and bottom. They were those who owned diversified portfolios of productive assets, businesses, stocks, real estate, and refused to abandon long-term strategies in a short-term panic. A plan doesn't guarantee you'll never see your portfolio drop. It guarantees that when it does, you'll know exactly what you're going to do and what you're not going to do. Fourth, insurance and protection. In personal finance, that means health insurance, life insurance for those who depend on you, and sometimes disability or income protection. In national finance, it means foreign currency reserves, diversified trade partners, and robust institutions. Insurance is the part of your plan you hope you never use, but when catastrophe strikes, it's money that appears exactly when you need it most. History is filled with people who were doing okay financially, until one uninsured event wiped them out. Finally, a plan is not a document you write once and forget. The world changes, your life changes. New risks emerge, technologies, diseases, political shifts, climate events. A living financial plan is reviewed regularly and adjusted as needed, the way a pilot constantly makes small corrections to stay on course. The principle stays the same: protect the downside, build for the long term. But the details evolve with reality. That ability to adjust is why a plan, not a prediction, is the real source of security. When you understand all this, history stops feeling like a random series of booms and busts and starts to look more like a long stress test of human preparation. The Great Depression punished a world built on leverage and denial, and rewarded the few who kept cash and avoided mania. The inflation of the 1970s punished those who trusted only in fixed promises and rewarded those who owned real assets. The 2008 crisis punished reckless borrowing and rewarded those with buffers and diversification. COVID-19 punished fragility and rewarded those countries that had built room to breathe. Today, we stand at another crossroads. We don't know exactly what the next crisis will be or when it will explode onto our screens. But we do know this: there will be one, and when it comes, markets will move too quickly for you to design a strategy on the fly. By the time the headlines are screaming, the best options are already taken. The real work, the work that saves careers, homes, retirements, even entire nations, is done in the quiet years, long before anyone realizes how important it was. In the end, a financial plan is not about predicting the future. It's about refusing to be its victim. It's the invisible shield that saved millions before, in banks that didn't fail, in families that didn't lose homes, in investors who didn't sell at the bottom, in countries that didn't go bankrupt when their neighbors did. And it may be the only thing standing between you and whatever comes next. You've been watching Hidden Finance, where we dig beneath the headlines to uncover the quiet decisions that decide who survives, who prospers, and who gets left behind. If you want to be on the right side of that history, start building your plan now. Because the future always belongs to those who prepare for it before it arrives.